Since the beginning of the year, I started the saving challenge and I document step by step on this YouTube channel the challenges, the troubles and the mistakes of a casual retail investor as I am. In order to document it with full transparency, I opened a dedicated account on Trade Republic, and all the money collected for this challenge is invested in this account. To achieve my targets, I have planned a very simple investing strategy based on two pillars. An emergency fund equivalent to approximately 6 months of expenses is collected in the Trade Republic cash deposit, always available at 3.25% annual interest paid monthly. In absolute values, I am not willing to accumulate here more than €15,000. All the rest is invested in an ETF tracking the S&P 500. In this ETF, I try to invest as much as I can. My plan is to reach the epic threshold of €100,000 as fast as possible and see if this will skyrocket my wealth or not, as mostly promised by all these YouTube videos. The platform, in fact, is full of videos that explain how, in theory, after the first 100,000 you will get easily rich. The aim of this channel instead is to document step by step what really happens in the life of a common retail investor, as opposed to what could only theoretically happen. Since the beginning of 2024, I have so far invested €19,000 in the ETF and €8,000 in the cash deposit, and every month I post a video to show you my progress. In total so far, I have saved and invested €27,000 in 11 months, equivalent to €2,500 per month, with a very positive return of my ETF of about 14%. So if you are curious to see what is going to happen next, then subscribe to the channel. Alright guys, now I would like to give you some more details about the ETF I choose and why. At the end of my €100,000 challenge, if things go as expected, I will be invested around 90% in the stock market and 10% in the cash deposit. Someone might here point out that this investing strategy is a bit too much unbalanced on the stock market and breaking the common sense rule of 60-40 that the majority of the retail investors are following. Yes, I agree on that, and I'm conscious on the risk related. Moreover, investing in the S&P 500 only exposes my investments to the American market and to the destiny of the Magnificent Seven. Without differentiation, I am basically dependent on the return of the US economy, and in particular of the 7 biggest technological companies that alone weighs approximately 30% of the S&P 500 and are able to strongly influence the yearly return of this market index. The only hope I have is that the S&P 500 will keep on following its historical series, also in the future granting the famous average 8% that has returned in the last decades. Why did I decide for such an aggressive strategy? First point, I evaluated the risks and agreed to risk more in the first phases of my investments. This will also train myself to get more confident with the stronger market fluctuations and the psychology of investments. Second point, choosing a world ETF would have reduced the risk and exposure to US, but also reduced the overall performance in the first investment phases. Third point, I can always differentiate by adding more investment assets or ETF tracking other markets at any time in the future. I prefer this approach as opposed to invest in a world ETF because it gives me more freedom in the weight I can give to the different assets or markets in the future. The disadvantage is of course a more difficult management and probably higher fees in a long run. In other words, my goal was also to maximize the returns as much as possible in exchange to a higher risk. Of course, there are thousands of riskier and more speculative trades or investment available on the market. This is the one I choose accordingly to my risk and investing profile. The ETF I choose for my saving plan is the European equivalent of the famous iShares IVV ETF. Let's have a quick look to the details. As you know, the ETF have different names depending on the market where they are traded. In Europe, the equivalent to the iShares IVV is called CSPX, and in Germany is traded with the ticker SXR8. As known, this ETF is issued by iShares, one of the world's largest ETF providers, belonging to BlackRock, the well-known giant investing company. The most important criteria I choose to select the ETF are the following. The first criteria is the size of the ETF. The size of the ETF is very important because it has a strong influence on the value of the ETF and the gap between the bid and ask. In other words, a bigger sized ETF will be more likely traded a lot, and this will reduce the difference between the price at which the investors are willing to buy the ETF and the value at which the ETF is effectively sold. In other words, the more a good is traded, the more the market of that good gets efficient and offer more options for positive trades. If you can imagine a market with only one seller and one buyer, it is most unlikely that they both will find a good deal. On the opposite side, a market with infinite individuals will be able to absorb all requests of the market in terms of supply and demand. The second criteria that I used to choose my ETF was the cost. Being it is a long-time investment, hopefully, the impact of the cost is very important. I choose iShares because compared to Vanguard has a fee of only 0.07% per year. The third criteria was the physical replication. This means that the underlying stocks are physically owned by the fund and not owned by third parties. This also means that the index is not replicated by derivative or other underlying financial products. The fourth criteria is the accumulating factor. About this topic we could open a book, but in a nutshell, since in my country the capital gain is taxed with more than 25%, it would not be efficient to receive the dividends and reinvest them afterwards, because I would lose a third of their value in this operation. Basically, I do not need in this moment of my life additional cash flow, and for this reason I prefer to let the ETF reinvest the dividends in the ETF itself. In the moment I will need additional cash flow, I can always move the capital on a distributing ETF. Lastly, the exchange rate coverage. I decided for an ETF without exchange rate coverage because usually this insurance has a cost, which again in a long run has a big impact, and because I think that the fluctuations around the dollar and euro will be always stay around 1-to-1, and this will compensate themselves automatically. Do you use the same investing strategy as I do? How do you choose your ETF? If you wanted to share your strategy, leave your comment here below. Moreover, do not forget to subscribe to the channel and watch the next upcoming financial update to check if this investing strategy will pay off or not. I hope that this excerpt of my investing strategy and the way I choose my ETF was of interest for you. If so, a like will motivate me to upload more videos like this. Alright guys, thanks for watching. Until the next one, take care. Bye!